If you went to bed last Friday night with a smug smile, thinking you were a billionaire because your portfolio was loaded with gold and silver, I have bad news. You just woke up to the worst nightmare of the decade. The clock strikes 6 a.m. on Monday. Instead of chirping birds, what jolted millions of global investors awake this morning was the relentless ringing of their broker hotlines. Margin call, and forced liquidation. In just 48 short hours, the global financial markets have turned into a literal slaughterhouse. No gunfire, no smoke, but the devastation rivals any battlefield. The bleeding red numbers on the electronic boards are dancing a macabre dance of death. $7.4 trillion. Stop for a second and let that number sink in. That is the amount of wealth that evaporated from the precious metals market overnight. That figure is larger than the combined GDP of the UK and France. It is 3 times the total value of the entire crypto market at its absolute peak. 5 years of gains. Wiped clean as if they never existed. This is a catastrophic collapse. From a dazzling peak of $120 an ounce on Friday, silver has been ruthlessly hammered down to $80 this morning. A 30% loss in the time it took you to finish your morning. Coffee, 1/3 of your assets vanished. Panic sell orders piled up, choking even the world's largest exchanges in London and New York. What on earth is happening in this February of 2026? Why has history's safest bunker suddenly turned into a death trap, burying millions of accounts? And more importantly, who is the invisible hand, powerful enough to crash a multi-trillion-dollar market with just a snap of their fingers? The answer doesn't lie in a gold mine or a mint. It lies squarely in one name and one signature just announced in Washington. Welcome back. Today, we dissect the Black Monday of precious metals investors. Let's rewind the clock a bit. About 1 week ago, the world was drunk on the commodity supercycle. What did we see? Escalating Russia-Ukraine tensions, rumors of the dollar's collapse, and most importantly, fear. When people are afraid, they buy gold. When people get greedy, they buy silver. Silver prices touched unimaginable thresholds, $120 an ounce. Financial forums, from Wall Street bets to investment groups across Asia, were screaming, silver to $200, gold to $10,000. That was exactly when the mousetrap was set. On the morning of February 2, 2026, CNBC ran the headline, "Historic Plunge." The sell-off didn't come from retail investors, it came from the whales, the institutional investors. Sell orders were triggered automatically at the speed of light. Gold plummeted from a peak of $5,600 to the $4,700 zone. Nearly 1,000 points. Gone. Stop-loss orders from retail investors were wiped out like a tsunami sweeping away a village. Silver fared even worse. It fell vertically from $120 to $80, an intraday drop of 36%. This is the worst crash since the Hunt brothers tried to corner the silver market in 1980. Why crash right now? It wasn't a coincidence. The direct trigger was President Donald Trump officially nominating Kevin Warsh as the next chairman of the Federal Reserve, Fed. Why is this name so terrifying? Kevin Warsh is not a gentle dove looking to print money. He is an ultra-hawk. Warsh's philosophy is simple. Inflation is public enemy number 1. If I have to kill the stock market or the gold market to kill inflation, I will do it. The moment Warsh's name appeared, U.S. Treasury yields spiked. The dollar went parabolic, and naturally, the dollar's enemies, gold and silver, had to die. In this section, we are going to drill down into 3 layers of analysis that the mainstream media usually skims over. First, the rule of buy the rumor, sell the news. The financial market is a machine that discounts the future. For the past 6 months, gold and silver rallied because people speculated that the Fed would cut rates, that the war would spread, that Trump would weaken the dollar to boost exports. But what is the reality? Trump picked Kevin Warsh. This signals that rates will be higher for longer. When reality contradicts expectation, the bubble bursts. The big boys on Wall Street knew this beforehand. They quietly took profits at the top, and last Monday, they simply dumped the rest of their bags onto the retail investors, who were still dreaming of the easy money era. Second, why did silver die a harder death than gold? Remember this saying, gold is the money of kings, silver is the money of gamblers. Silver's volatility is always 2 to 3 times that of gold. In this recent rally, silver didn't rise because of industrial demand. It rose because of FOMO, fear of missing out. Millions of amateur investors used leverage, borrowed money, to buy silver at $100, $110, when the price hit $100 minus. When it hit $90, the brokers issued margin calls. When they couldn't deposit more cash, the brokers executed forced liquidations. A cascade of forced sell orders flooded the market simultaneously, pushing the price down to $80. This is called the snowball effect. Today's silver crash is the price paid for excessive greed and leverage. Third, the geopolitical angle, a punch to China and Russia. This is the most interesting angle that few noticed. Who has been the biggest buyer of gold in the last 3 years? The central banks of China and Russia. Why do they hoard gold? To de-dollarize. They want to back their currencies with gold to escape U.S. control. Appointing Kevin Warsh and strengthening the U.S. dollar is a brutal act of currency warfare. Overnight, the value of Russia and China's foreign reserves, denominated in gold, evaporated by hundreds of billions of dollars. The U.S. is sending a message. You want to ditch the dollar to play the gold game? Fine, I'll crash gold so you can see who the real boss is. It's not just about profit and loss on the ticker. This is a political chess move. The U.S. accepted short-term pain to cripple the financial ambitions of its strategic rivals. Looking at the technicals, a clear double-top pattern has formed on the gold chart. The RSI has been screaming overbought for 3 months straight. A correction was inevitable, but the brutality lies in the speed. Usually, a 30% correction takes 3 to 6 months to play out. Over the last 48 hours, many held on to the hope. If physical gold crashes, capital will flow into digital gold, but reality just delivered a brutal slap to that theory. Bitcoin didn't just fail to rally. It smashed through the critical $90,000 support level, dragging the entire altcoin market into a bloodbath. Why? This is a textbook lesson in a liquidity crisis. When major funds get crushed in the silver market, they are forced to sell anything liquid to cover their margin calls. And Bitcoin, trading 24/7, becomes the ATM they use to withdraw cash to plug their holes. Kevin Warsh isn't just an enemy of gold, he is the nemesis of all risk assets. A hawkish Fed chair means cheap money. The oxygen for crypto and AI tech stocks is getting cut off. Look at tech stocks this morning. Nvidia, Microsoft, Tesla, all swimming in a sea of red. Why? Because their valuation models rely on low interest rates. When rate expectations spike, their valuations collapse. This event proves a cruel truth. In a real panic, cash is king. Every other asset, whether it's gold bars or blockchain code, gets sold off without mercy. Furthermore, we need to talk about the media trap. Did you notice? Exactly 3 days before the crash, mainstream headlines were in sync. Silver is the next Bitcoin. Global silver shortage imminent. That wasn't news. That was bait. The market makers used the media to herd the retail crowd into buying the top, creating exit liquidity for themselves. The moment the last bullish article was published was the moment the massive short orders were triggered. If you bought the headlines, you became lunch for the sharks. The event of February 2nd, 2026, will be written into financial history books as a testament to the ruthlessness of the market. It teaches us 3 expensive lessons. Nothing goes up forever. When your Uber driver asks you how to buy silver, that is the signal to sell and run as fast as you can. Don't fight the Fed. No matter how much money you have, you cannot beat the money printer and the interest rate decisions of the United States. Kevin Warsh taking the helm means the era of cheap money is over. Gold is a bunker, but bunkers can collapse. Never put 100% of your assets into a single channel, even if experts call it the safest. So, the million-dollar question now is this the bottom, or will gold return to $3,000 and silver to $50? My view, don't try to catch a falling knife. Wait for the corpses of the leveraged accounts to be cleared out. Wait for the market to calm down. When the bleeding stops, that's when we consider re-entering. What about you? Are you bag-holding silver at $120, or did you manage to escape? What do you think about the new Fed chair Kevin Warsh? Is he the inflation-fighting savior or the destroyer of wealth? Leave your thoughts in the comments below. Your debate is the biggest value of this channel. Don't forget to like, subscribe, and hit the notification bell because in this insane market, information delayed by 1 second means money lost. Stop looking at the spot price of $91. That number is a lie. Right now, as you watch this video, the price of silver in Shanghai, China has already exploded past $114. $114 an ounce. That is an $11 to $12 premium over the COMEX price in the United States. In percentage terms, that is a massive arbitrage gap. But if you think that spread is shocking, what is happening inside the United States is even worse. The system has effectively seized up. We have received official confirmation that the United States Mint, the sovereign producer of the American Silver Eagle, has ceased operations on silver sales. They have shut the doors. Their official statement claims they need to evaluate pricing adjustments. Let me translate that from bureaucratic speak into plain English. It means the price of silver is rising so rapidly, so violently, that the US government cannot update their website fast enough to stay profitable. They are literally terrified of selling dollars for dimes. They realized that their fixed pricing models were being arbitraged by the market, and rather than losing money on every ounce sold, they simply pulled the plug, and they aren't the only ones. Costco, the retail giant, is now rationing bars like we are in a wartime economy. They have instituted a hard limit, 1 transaction per membership with a maximum of 10 units per 24 hours. And even with those limits, the inventory is flashing sold out almost immediately. We are watching a commercial signal failure. The West is trying to suppress the price to keep the illusion of currency stability, while the East is draining the vaults at any price necessary. Even $114. And in the middle of this chaos, the CME Group has dropped a nuclear option on margin requirements that changes the rules of the game forever. If you thought $91 was the story, you are missing the forest for the trees. The real story is that the physical market has decoupled from the digital price feed. This is not just a bull run. This is a paradigm shift. While the physical metal is disappearing from the US Mint and Costco, the paper markets are launching a desperate counterattack. Faced with this runaway train, the exchange authorities have made a historic, unprecedented change to the rules of engagement. We are calling it the eternal margin nuke. Traditionally, when you trade a futures contract for gold, silver, platinum, or palladium, the exchange sets a margin requirement, a fixed dollar amount. For example, to hold 5,000 ounces of silver, you might need to put up $32,000. It was a manual, deliberate process. That system is gone. Earlier this week, the CME Group announced they are switching from a fixed dollar margin to a percentage of notional value. They are effectively pegging the margin requirement to roughly 9% of the total contract value. Why is this huge? Because it automates the pain for the bulls. Let's break down the math. A standard silver contract is 5,000 ounces at $91 an ounce. That contract is worth $455,000. $455,000. Under the new rule, you need 9% of that in cash, roughly $41,000. But here is the trap. As the price of silver goes up, the value of the contract goes up. Therefore, the 9% margin requirement goes up automatically if silver hits $100. The contract is worth $500,000, and your margin requirement jumps instantly. If it hits $150, it jumps again. This acts as an automatic braking system on the price. Every time silver rallies, it becomes more expensive to hold the position. It forces leverage out of the system. It creates a scenario where traders are constantly hit with margin calls simply because their asset is performing well. Some might argue this is just to streamline operations. But if you look at the timing, right as silver goes parabolic, right as the physical shortage hits, it looks like a desperate suppression tactic. It looks like the COMEX saying, we cannot afford to let this market run, so we are going to make it prohibitively expensive to participate. It is a Hail Mary attempt to save the short sellers. But here's the flaw in their logic. This only affects the paper speculators. It does not stop China from buying physical bars. It does not stop the US Mint from running out of coins. All this does is widen the disconnect between the fake paper price and the real physical price. Let's circle back to the implication of the US Mint shutting down, because it is critical to understand the economic gravity of this. This is exactly what happens during a hyperinflationary event or a currency collapse. You walk into a store and there are no goods on the shelves, not because the goods don't exist, but because the store owner doesn't know what to charge you. If he sells you a loaf of bread for $5 today, but it costs him $10 to replace it tomorrow, he goes out of business. The U.S. Mint is currently facing that exact dilemma. They are paralyzed by the velocity of the currency debasement relative to silver. This is not a private dealer. This is the sovereign mint. When the government stops selling its own money, silver eagles, and when the biggest retailer in America, Costco, has to ration a commodity, price discovery on the screen becomes irrelevant. The price of silver isn't $91 if you can't buy it for $91. The real price is unobtainium. We are seeing the physical market decouple from the digital price feed. The dealers are backed up, shipping times are delayed, and the banners on every bullion website are asking for patience. This is what a supply squeeze looks like in real time. While the West struggles to price silver and manage margin calls, the East has already moved on. This East-West divide is a geopolitical economic war. In a functioning, efficient global market, an arbitrage gap of this size, $91 vs $114, shouldn't happen. Traders would buy every ounce in New York, fly it to Shanghai, sell it, and pocket the risk-free profit. That process should bring the prices back together, but the spread remains. Why? Because the metal isn't moving fast enough. Or, more frighteningly, because the metal available in the West is paper silver derivative contracts that cannot be easily converted into the physical bars needed to satisfy the Chinese appetite. China is bidding for physical delivery. They are draining the global supply. They don't care about the COMEX closing price, they care about possession. We are seeing a massive flow of physical wealth from west to east. The West, specifically the US and London, has suppressed the paper price of metals for years to make the dollar and the pound look stronger than they are. But China, knowing the geopolitical landscape is fracturing, is calling the bluff. They are saying, we will pay the real market price, and that price is over $100. This puts the COMEX in a death spiral. If they don't let the price rise to match Shanghai, their vaults will be emptied. If they do let the price rise, it exposes the inflation and currency weakness they have been trying to hide. We are watching the end of Western price dominance in precious metals. Markets do not move in a vacuum. This silver explosion is being fueled by a backdrop of extreme political instability in the United States and abroad. According to analysis from Bloomberg, this rally is being driven by a combination of the Trump trade and uncertainty surrounding the Federal Reserve. There is a growing narrative in the market regarding the independence of the Federal Reserve. We are hearing reports and rumors about potential criminal indictments against Fed Chair Jerome Powell, or at the very least, a significant push to remove him from power. The market hates uncertainty, but the precious metals market loves it. If the independence of the central bank is compromised, or if the market believes the next Fed chair will be a political appointee instructed to slash rates to zero, the dollar is effectively dead in the water. Lower rates and a politicized central bank are the ultimate rocket fuel for gold and silver. Investors are front-running this possibility. They are buying insurance against a regime change in monetary policy. Add to this the aggressive foreign policy moves we are seeing. The transcript highlights tensions involving the Trump administration's actions in Venezuela, capture of leadership, and renewed rhetoric regarding the acquisition of Greenland. These are not normal geopolitical maneuvers. They signal a return to a more aggressive, imperial style of resource acquisition when the world sees the U.S. becoming unpredictable on the global stage. And when they see internal strife in Iran with violent protests threatening the regime, capital seeks safety. Safe haven assets are not just about inflation, they are about political risk. Right now, the political risk meter is in the red. Investors are looking at the U.S. debt, the political infighting, the geopolitical aggression, and they are saying, I don't want dollars. I want something with no counterparty risk. That something is gold and silver. Despite all of this, the $91 price, the shortages, the margin hikes, the $114 China price, the most incredible thing is that we haven't even seen the mania yet. If you look back at 1980, when the Hunt brothers cornered the market, or 2011, when silver nearly hit $50, those were periods of public hysteria. People were lining up around the block to sell their grandmother's silverware, or to buy coins. We aren't there yet. The retail public is just waking up. The buying we are seeing right now is institutional. It is sovereign. It is the smart money moving first. The average person on the street has no idea that silver is at $91. They have no idea the mint has shut down. This suggests that we are still in the early to middle innings of this move. When the mainstream media starts covering this 24/7, when your taxi driver gives you stock tips on silver miners, that is the top. We are far from that sentiment. Citigroup has upgraded their forecast to $100 silver and $5,000 gold in the next 3 months, but honestly, that feels conservative. If China is already paying $114, why would the price stop at $100 in the US? The ceiling has been blown off. The inflation-adjusted high from 1,980 is the only record left to beat, and given the rate of currency creation since then, silver could theoretically go much, much higher before it reaches true equilibrium. To wrap up this analysis, we have to look at the consequences. What happens next? We are likely going to see a period of extreme volatility. The COMEX margin changes will force some paper hands to fold, creating temporary dips. But those dips will likely be bought aggressively by the physical market. The floor has moved up. The US Mint will eventually reopen sales, but you can guarantee the prices will be significantly higher. They aren't going to sell silver at a loss. The premiums on physical metal will likely stay elevated or expand further. We are moving into a two-tier market. The paper price shown on CNBC, which might be managed and suppressed, and the street price, or Shanghai price, which is the actual cost to acquire metal. For the investor, the lesson is clear. Do not rely on the spot price to tell you the value of your asset. The spot price is becoming a fiction. The true value is determined by availability. If you cannot get it, the price is infinite. We are witnessing the slow-motion death of the fractional reserve bullion banking system. They sold more paper silver than exists in reality, and now the holders of those contracts, led by China, are standing at the cold delivery window asking for their bars. The window is closing, the mint is closed, Costco is limited. The question you need to ask yourself is not will silver go to $100? It is already there in the places that matter. The question is, what will you hold when the paper market finally admits it has nothing left to deliver? Gandalf the Grey, or rather, the meme version of him mentioned in the news, said it best. Hold on tight to your physical gold and silver, you fools. It's satire, but it's also the best financial advice of the decade. The ratio is dropping, the price is climbing, and the exits are being blocked by margin hikes and sales suspensions. We will continue to monitor this historic squeeze. As the East continues to bid up the price and the West struggles to maintain the illusion of control, one thing is certain. The silver market you knew yesterday is gone. Welcome to the era of true price discovery. Thank you for listening. This has been a special report on the silver crisis. Keep your eyes on the Shanghai spread and prepare for volatility. Welcome back to the channel. If you've been holding silver, you are likely sitting on the best trade of your life. We have officially breached the unthinkable. Silver has shattered the ceiling, trading upwards of $90 an ounce. We are talking about a 200% rally in a single year. The euphoria is real. The silver squeeze we've talked about for a decade, it looks like it finally arrived. But before you go out and buy that Lamborghini, you need to listen very closely. Because while the retail crowd is popping champagne, the institutional giants, the smart money, are quietly positioning their hands over the sell button. We are looking at a massive structural correction looming in 2026, a crash that could wipe out 30% of your gains in weeks. Why? Because of a $7 billion forced liquidation event and a silent economic war between Washington and Beijing that is about to turn the commodities market into a battlefield. Is silver dead? No. But is it about to punish the latecomers? Absolutely. Today, we break down the warning signs, the supercycle rotation into copper, and why the US tariff decision tonight changes everything. Let's dive in. First, let's look at the data coming out of the latest market rounds. We just reviewed the analysis from Ajay Kidia of Kidia Advisory, and the numbers are staggering. The fundamental drivers that push silver to $90 are legitimate. We have a chronic supply deficit. We have witnessed an additional 200 million ounces of demand sucked up by ETFs alone. The industrial hunger, specifically from the EV sector and the solar photovoltaic industry, has been insatiable. Kedia notes that while they expected silver to hit $75 or $80 over 2 years, it did it in one. This is what we call a parabolic move. However, Kedia dropped the bombshell forecast for 2026. Despite the bullish long-term fundamentals, de-dollarization, interest rate cuts, and geopolitical tension, he is calling for extreme caution. The forecast suggests a sharp correction of 25% to 30%. Why? History is rhyming. We saw this in 1980 with the Hunt brothers, we saw it in 2011, we saw it in 2020. When silver goes vertical, it doesn't plateau, it crashes. But this time, the trigger isn't just sentiment, it's a mechanism called the BCOM rebalancing, and it involves billions of dollars moving out of precious metals and into the new king of the supercycle, copper. Now, let's peel back the layers. Why is a crash predicted right when silver looks invincible? We need to look at three critical battlefronts: the institutional algorithmic sell-off, the US-China trade war, and the rise of the strategic metals. The $7 billion institutional rug pull. You need to understand how the big boys play. The transcript highlights a critical event, the Bloomberg Commodity Index, BCOM, and rebalancing. Here is how the game works. Indices have caps. When an asset class like gold and silver performs too well, it exceeds its allocation limit, in this case, 15%. To stay within the rules, these massive passive funds are forced to sell the winners to buy the losers. Kedia estimates this will drag down $7 billion from gold and $7 billion from silver. This isn't emotional selling, it's mathematical selling. It's an algorithmic rug pull. When $7 billion of selling pressure hits the market simultaneously, price discovery breaks, and we see that 30% dip. For the retail investor unaware of this mechanism, it looks like the world is ending. For the smart money, it's a scheduled discount shopping spree, the US-China tariff war, the geopolitical trigger. The analysis mentions that the court for us tariff outcome is due tonight. This is where the geopolitics gets dirty. Silver is no longer just money. It is a war material. It is essential for the green energy transition. And who controls the green energy manufacturing supply chain? China. China dominates solar panel production, which is the primary industrial user of silver. The United States, specifically under the current protectionist trends, is aggressively slapping tariffs on Chinese exports to cripple their dominance. If the US imposes harsh tariffs tonight, Chinese solar exports stall. If Chinese factories slow down, their demand for physical silver takes a temporary hit. The market hates uncertainty. A trade war escalation is the perfect excuse for hedge funds to short silver, claiming demand destruction in China. This is the silent war, using trade policy to manipulate commodity prices, hurting Chinese manufacturing while the West stockpiles the metal at lower prices during the dip, the Great Rotation. Copper is the new oil, while silver takes a breather. Look at where the capital is flowing. The analysis points to copper hitting record peaks, targeting $15,000 to $16,000 per ton on the LME. Why the rotation? Because we are entering the base metal phase of the commodity supercycle. Silver is for wealth preservation and electronics. Copper is for infrastructure and remilitarization. As the US tries to decouple from China and rebuild its own grid, and as AI data centers demand massive amounts of power, copper is becoming the most strategic asset on the planet. The funds are moving out of bullion and into copper. This is a tactical shift. In a world of conflict, you buy the metal that builds the grid and the weapons first. Copper is leading the charge, and silver is being temporarily sacrificed to fund that trade. Let's talk about the psychology of 2026. If this 30% crash happens, it will be terrifying. You will see headlines saying the silver bubble has burst. You will see pundits claiming the industrial demand was a hoax. This is designed to shake you out. Remember Kedia's long-term target, $100 to $110. The fundamentals haven't changed. The deficit is still there. The US debt is still exploding, requiring de-dollarization. The structural reality is that the world is running out of silver. However, Wall Street cannot let retail investors ride the elevator all the way to the top. They need volatility. They need to crash the price back down to the $60, $70 range to re-enter their positions before the final run to triple digits. This crash is actually a transfer of wealth mechanism. It transfers silver from the impatient hands of the retail public to the patient vaults of the institutions and central banks who know the true value of hard assets in a high-inflation, fractured geopolitical world. So, how do we navigate this minefield? We have a volatile year ahead, caught between the crossfire of US-China trade wars and algorithmic liquidations. Here is the playbook based on the data we have analyzed. Number 1. Don't chase the parabolic move. If you are buying silver today at $90 hoping for a quick flip to $100 next week, you are gambling, not investing. The risk-to-reward ratio is currently terrible. You are picking up pennies in front of a steamroller. Number 2, watch the copper rotation. If you want to stay in commodities, follow the smart money. The rotation into copper is real, with a target of $16,000 on the LME and a 30% upside. Copper might be the hedge you need to balance your portfolio while silver cools off. As Kedia said, copper is the barometer of the economy, and right now, the barometer is screaming inflation. Number 3, prepare for the re-entry. If the US tariffs hit hard tonight, and the BCOM rebalancing triggers that $7 billion sell-off, we will see a violent correction. Do not panic. Do not sell your stack in fear. Instead, view this as a second chance. If silver drops to $65 or $70, that is the buy zone. That is where the long-term support lies. That is where you position yourself for the run to $110 and beyond. In late 2026 or 2027, the US and China are locked in a struggle for resource dominance. They are playing a long game. The volatility we are about to see is just the noise of battle. The trend is up, but the road is about to get very, very bumpy. Outro. I want to hear from you. Do you think the $90 price tag is sustainable, or are we about to witness a historic crash? Are you worried about the US tariffs impacting the market? And crucially, are you rotating any of your funds into copper, or are you silver only regardless of the pain? Leave your thoughts in the comments below. We read every single one. If you found value in this deep dive, make sure to hit that like button. It helps us beat the algorithm that tries to suppress this kind of financial truth. Subscribe and turn on notifications so you don't miss the update when the tariffs officially hit. Stay liquid, stay sharp, and don't let them shake you out. I'll see you in the next one.